Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Good morning, Paul, and good morning to all of our viewers and our listeners out there. Welcome back. If it's Tuesday, we are talking real estate. It is Tuesday, and we are going to talk real estate. And Paul, as you mentioned, stuck in the middle. That's me. Getting pulled one direction, get pulled the other direction. We're going to try and sort it out. We're going to do a little bit different format on our show today. I'm excited. We have Paul has remodeled the studio to some degree.
Low-profile microphones.
We have new microphones. We have gotten rid of our plexiglass, and then I thought, just as a transition, we would do a show with no guests so that I don't have to worry about being exposed.
That's right.
So we're trying some different stuff this morning. But so today's topic of our show, with no guest, it's just going to be Paul and I, is we're going to talk about the current market updates, and we're going to talk about cap rates. We're going to talk about returns. We're going to talk about investment, where it was, where it is today, where we think it's going, something that I sort of live with on a daily basis in terms of deals that we're looking at, and so thought it would be pertinent for those who care.
And is it getting any better or different? Because one of the things that struck me over the last year, let's say, that we've been doing this show, we've done it longer than, but over this last year, is you bring people in and you say, hey, this deal doesn't pencil. I know, but hopefully it will someday.
Yeah, well, it's interesting because we are coming up on our almost 100th episode, which I don't know. I think I get a free donut or something.
You get something big. Yeah. I'm not sure what it is.
You get me something big, like a ribbon or something, put it on my chest. But we've been doing this a while now, and I go back and I listen to some of the old initial interviews, and I would ask people, what's the future of the market? And they say, oh, it's great, it's all good, everything's good, right? Then you fast forward and you go back 6-9 months, and they're like, I don't know, it's getting worse. And now the question is, what is it? Is it soft landing? Are things gonna change between now and the election? Is it gonna have any impact on it? And then what's going on with interest rates, and how does that affect what's happening in the real world? So that's what I thought I'd talk about. I don't have any crystal ball in terms of where it's going to be or where interest rates are going to be, but I can tell you and the viewers and the listeners out there, what we're seeing in the market in terms of real time.
So in terms of real time, is it really changing, or are we still in choppy waters? Up, down, maybe?
Well, I say that you have to break it down, right? So there's the value of real estate. So for those who care about the value of their house or the housing market, there is the commercial markets, there are the apartment markets. You have to break each of those down separately. But those, to me, are dictated by two main things. Number one is supply and demand.
Right.
And then the second is interest rates. And then the third, if you were going to rank them, I think, would be people's perception of where the market is headed. Because if people perceive that the market is headed down, they will not buy. They will sit on the fence and they will wait and see what happens. If people believe the market's going back up, then they will get off the fence and they will start to buy. I don't think that that's there today. And then the other issue is, what happens if it's neither of those and you just don't know, which is where we're at, really. The people who are buying, the people who are selling, the people who are making deals are the people that have to, not because it's not this was such a good deal that I couldn't refuse. There's an event, somebody passes away, some partners get in an argument, there's a loan coming due, I'm moving to a bigger house, I'm moving out of state, I'm retiring. These are events that would change, that would dictate I need to make a deal. It doesn't necessarily make somebody desperate, but I need to be a seller. And then on the buy side, you have plenty of people that still have money, but looking for an opportunity that makes sense. And if it doesn't make sense, or they can't get a reasonable loan on it, if they were going to put a loan on it, then they go, I'll pass and I'll just keep sitting tight. And then that's what you see people doing.
So I know this isn't a residential real estate show, but clearly I understand residential real estate, my own real estate, probably better than I do what you guys are doing. It still makes my head spin on different categories and cap rates and all this kind of stuff here. So the two assumptions I had a year ago was that everybody was sitting on the sideline, lower inventory than ever in recent memory. Nobody's selling. Everybody's waiting to see what's going to happen. And the assumption was that interest rates were going to drive prices down. as interest rates went up, people couldn't afford to pay anymore. So prices eventually would start to either stop going up or start to come down.
And you haven't seen that, have you?
I haven't seen that.
Right. So let's talk the residential, and then we'll dovetail into the commercial. On the residential side, again, I don't want to pretend to be the end-all expert, but the reason that you haven't seen the prices come down on the residential side is back to that supply-demand. There's still limited supply.
Right.
Right. And so the fact that interest rates have gone up on the lower to middle size priced homes, right, wherever you are in whatever market you're in, those prices have not dropped because there's still more buyers than there are inventory.
Right.
And the interest rate going up, while it certainly inhibits your ability to borrow, it certainly inhibits your ability to pay more, and it affects your mortgage at the end of the day. What's the alternative? If I'm renting, my rent went up, I might as well buy because I can go back and refinance later if the rates come down, and I really just don't want to keep paying rent. If I need a bigger house, if I need a different house, I need a yard, I need a basement, whatever it is, I have an event, I need to do it. It's worth it for me to do it. On the higher end homes,
But how can you do it? At some point, you reach a point, even though I want
well,
to
you
do
look,
it.
you keep looking, and you look for an opportunity. And so there are opportunities out there. You just have to be diligent and then ready to jump on it. Now, the flip side of it is, if you rewind 12 months ago, you had 10 offers, 15 offers on a house, and you were in a bidding war. That's not the case today. That
No.
doesn't mean that there's no activity, but what it does mean is, I mean, there's homes in my neighborhood and there's no offers, right? And so it's 30 days in, and what happens? After 30 days, they have a price drop, and then you see if you get some more offers.
It's not a drop, though. It's an improvement.
Right. There's no price drop. It's price improvement. That's the term of the year, which is right. So, and on the higher end homes, interest rate is not really as big of a factor because if you're buying a $5 million home or more, I don't think the interest rate is going to make or break your decision making at the end.
And many
of
are
the day.
buying cash at those levels anyway, as hard as it is.
Yeah, or foreign people paying cash, then
Or a lot of cash or whatever,
Right.
yeah.
So that's the residential side. I mean, we haven't seen prices drop. Activity still low. Inventory still low. And the people that are thinking about selling, if they have a 2 or 3% interest rate, what are they going to do? Why would you go?
Yeah.
You would only go if you had to go. To trade a 2 or 3% interest rate for 7.
So it doesn't sound like anything
It doesn't make any sense.
could change that in the short run. Over the next year, demand will still be high.
Yeah.
Interest rates aren't coming down. They may not go up anymore, so we're probably going to stabilize somewhere what the new interest rates are for a while. People kind of wrap their heads around that. So despite what we thought a year ago, I don't think prices are necessarily coming down.
No, but you don't see on the residential side the next house being listed for more than the last one dramatically.
No.
And then people who are sellers, right, still, once this house doesn't sell in a week and then it doesn't sell in a month, you will see these price improvements, partly because the price that they had it on was inflated in the first place.
It
So
was a
maybe it pulls
ridiculous
back.
number anyways.
Right.
It's a
So,
whole
so,
formula,
so
yeah.
you're beyond the top of the market, and now maybe you pull back to the top of the market or just below. You're still way ahead of the game. Right?
So you said something interesting on one of your other shows earlier this week, and you're talking about some people buying in the hope. We're suffering from too much hopium. We're not taking opium. We're taking hopium. You hope that maybe the interest rates will come down and I can refinance. So even though this is going to choke me for a while, my assumption is I'm going to buy something, and sooner or later the interest rates will come down and I'll refinance it. But in commercial, you get a prepayment penalty. You can't just...
Yeah, so that works in residential. It doesn't work in commercial. So let's shift gears to the commercial side of things. And so commercial is not on emotion. Commercial is not 100% supply and demand. And commercial is really based on, if it's an investment, it's a cap rate. It's a return on my investment.
And the
right?
cap rate, again, for those who, I know everybody in this show does, but just in case somebody doesn't understand the cap rate, it is what? It's
The cap rate is the return on your cash. So if you were purchasing pick a property, if you're purchasing a property for $1 million, and that property threw off $100,000 a year of net income, that would be a 10 cap.
Right.
Right. If that property threw off $20,000 a year, then that would be a 2 cap. Right. And so you have properties that are near the coast here in Southern California that we're selling at a no cap or a 1 cap or a 2 cap. Why? Because they could, because the market was tight and because people's perception was the property is going to continue to go up in value, and I don't really care what the return is. I just think property values will go up forever.
So I don't care if I'm making money, if it pencils out, as you say.
Well,
I buy it for this, and here's how much income it produces, and it produces a
Yeah,
1%, a 1 cap on my thing, or a no cap. I don't care, because I still think over time that thing will go up. I got two ways to make money. The value of the property goes up, or the amount of cash it throws off goes
Yes,
up.
and you have different motivations from different buyers. So a buyer that's in an exchange who just doesn't want to pay the taxes because they sold their property at some inflated, ridiculous number. They just don't want to pay the taxes.
They gotta go
so
park it
they'll
somewhere.
Right, they'll go park it.
The
and pay some-
1031 exchange, where you don't have to pay, you defer your tax as long as
Exactly.
it's equal to or greater than what you bought.
And those people are more motivated by not paying the taxes than they are about the return.
Right.
Right. And so then you have somebody else who is foreign money, or who is made money in the stock market and some other place, and then they want to park the money. Or you have somebody who says, look, I'm buying it and it's a value add. So I'm going to come in, I'm going to raise the rent, I'm going to fix up the property, and long term, I won't get a really low cap, whatever that number is. I'll be able to improve the cap rate. Right now, it used to be that if you bought something at a 4 or a 5 cap, which is a 4 or 5% return, and you could get a loan for, let's say, 3%, hypothetically, it's what they call an arbitrage of the cap rate, which means that if I put a loan for half at 3% and the whole property throws off 5%, my return on the half that I had to come up with cash is actually more like 6.5%. So I can increase my overall return by putting debt on the property, which is historically that's what people do. So
If you can get the debt low enough.
if you
If it's
could,
lower than what
well, so here's the dynamic, right? So if I rewind, I could pick a property type. I could have bought an office building for anywhere from 60 to 75%, and get a loan for 60 to 75%. I could have gotten an apartment building for anywhere from 60 to 75%, depending upon how the bank underwrites it, which means I only have to come up with 25 to 40% down.
Right.
Okay. And if I could have gotten that for 3 to 4%, and then I could buy it for a 4 to 5% return, and then I can raise the rents, I could realistically get a 6 or 7% return on my money. Now, remember, if you rewind again a year ago, interest rates for savings accounts were 2% or less, and so you couldn't get a return elsewhere, so it made sense to put that capital out in the market and go invest it. Okay, now let's fast forward to today. Today, I can get 4 to 5% in the bank by just leaving it CDs, money market account, investment account, right? Low risk to no risk. And so now, if I want to go buy a property and I want to buy it at a 4 cap, which is a 4% return, it's less than what I'm getting in the bank. And then if I want to put down half, let's say, on a property and go finance the rest, the interest rate today, I'm ballparking it because there's a range, but let's just say it's 7%. So I'm losing money on my return. So not only is it a worse investment than just doing nothing and leaving it in the bank, which leaves me with low to no motivation to make the deal. Also, if I buy it at a 4 cap and I borrow at 7, my return's really like 2. So I either better have some serious
because
upside.
you've got some cash in this deal, so you're not borrowing the whole value of the property.
Right.
At 7%.
Let's say you borrowed half. If you borrowed half at 7, right, and then you got a 4% return on the whole thing, the 7 would drain it.
Yeah.
Right? And so you're getting a 2% return. So I either have to have serious upside in raising the rents, or I remodel and I renovate, or
Or
do
you
something.
see serious rise in the value of the property over time.
But the only way on a commercial property for the property to rise in value is to raise the rent.
Right.
And so if I cannot raise the rent because I have existing leases in place, or I cannot raise the rent because I have to remodel, or I could refinance at a lower interest rate, I could help myself. Right? If interest rates went back to 3%, then I would get a better return. But
Because
they're not going to. Right? But they're not going to pull back to 3%. I mean,
Because
that's
commercial
over.
real estate was based not solely on supply and demand, how many people want to buy it, how many people are selling it.
It's based on a return.
Based on a return. Now, I'm going to give you one perhaps different case, which is industrial.
Right. So let's talk about that for a second. But the general concept which applies, I don't care if it's office, medical, industrial, apartments, if you're borrowing money and it costs you more to borrow it than the return that you're getting, you will drain your return even further. And then when you go to get a commercial loan, typically there is a prepay for 3 to 5 years on that money, unless you get a construction loan or a bridge loan or a hard money loan. But in that case, you're paying a premium on the
Paying a higher
interest rate
rate,
even
yeah.
more.
Right.
So it really makes it difficult to pencil. Now, a guy who's sitting on a bunch of cash, who says, hey, I could buy a property, I could fix it up, I could raise the rent, I could remodel, then I could go back later and put a loan on it. What is later? Is that 6 months or 12 months from now? So a guy pitched me a deal last week and said, you can do this, Barry. You can raise the rents are low, you can remodel it, and then you can go get a better loan in a year. And I said, what's a better loan? It's going to be 6.5% instead of 7%. And then there's still a cost to go get that loan. You got appraisal, bank fees, other things.
Right.
So it's not like interest rates are going to go from 7 back to 4, and then in a year you're going to wake up and be like, oh, it's yesterday's market again. You're not. So what? So then the question is, what has to give, right? And what has to give is the cap rate has to go up, because is an inverse relationship between the interest rate and the cap rate, and it doesn't hunt. So the cap rate has to go up, but the seller doesn't want to take less money, because as the cap rate goes up, the property is worth less.
Mm-hmm.
The broker doesn't want to tell the seller that his property is worth less because he wants the listing. Otherwise, some other broker will tell him, no, I can get you
Tell him
this
whatever he
number.
wants to hear to get the listing.
You
yeah.
get the listing, and then in 30 days you tell him, hey, the market's not there, we got to drop the price, but you're already in. So I don't tell the seller he's full of it. I don't tell the seller the market's something different, because I want the business. Why not? And I'm slower these days as a broker, not me, but I mean other guys are slower. So they go, what the hell? I'll take the listing, right? So they do, and then it sits, right? And maybe I get lucky and somebody pays me my number, but then I do the price improvement, right? And so my $1 million, let's just pick, right? My $1 million, just go $10 million property, which was probably only worth $8 million, right? They do a price improvement to $9.8 million, and then somebody gives them an offer at $9.5 million, and it's still $1.5 million over really where it should be.
Mm-hmm.
But somebody feels like they're getting a deal, and so maybe that's
Right.
how it goes. So when you go talk about industrial or you talk about office, so office rates dropped already with the pandemic. Office rates now are not dropping. You see higher concessions. You see higher vacancy.
Right.
So the building is worth less because there's more vacancy, and also it's more money to do construction for improvements. So you see the cap rates have moved on office. You see you have more vacancy, so there's more work to do. So you've seen prices come down on that. On the industrial side, if it's an investment deal for industrial, you've now seen the cap rates move. They're not trading at a 3 cap. Unless there's a reason. And the reason would be I have someone in at half of what the market rent is and their lease is up in a year. And so I'm either going to double their rent, or I'm going to tell them to leave and get someone else to pay market rent. And there is no rent control on commercial real estate in California or anywhere else that I'm aware of. So you can do that and you can get away with it.
Did you want us to push that idea? Is that
No,
a good
absolutely. I mean, look, it's free market, right? So it sucks for the tenant. But the fact of the matter is the tenant that's paying 50% rent has had a very good deal for however long that lease was, and that gig is up.
And there
so-
was no demand for industrial. Cities, by and large, wrote off that idea. Nobody wanted industrial in Costa Mesa or
Yeah, but
Irvine
you-
here or something.
Look, you have industrial being built in Irvine, right in the center of the industrial complex, because that actually is a better yield with a higher and better return than anything else.
I
That's
know.
why they're building it.
And who would have thought that 5 years ago?
So, but
Nobody.
even so, if a cap rate goes even from 4 to 5, right, then the value of the property is flattened. The other thing that we're getting pushed back on in deals that has just started really in the last 30 days is that the buyers don't believe that industrial rents will continue to go up at the pace that they've been going up in the future. So that if somebody is already paying the new rate, so if I was a seller, if I fixed up my building and I rented it at twice what I was getting from the last tenant, and then that rent goes up every year, a buyer might say, look, I don't trust it. You're going to get into numbers where I don't think a guy can pay.
Mm-hmm.
And then if the market flattens, then when that lease comes up, I'm going to go backwards, and it's going to inhibit my return. And so I'm not going to pay you what you want, because I don't believe that the market goes
That's
up
sustainable.
forever. Right.
Yeah,
I don't
right.
believe it's sustainable. And so, so that also starts to affect people's thinkings and the pricing, right? Now, if you're a broker, you can throw out all the comps you want. I don't really care as a buyer, because I just look at what works for me. And if
Yeah.
it doesn't work for me, then go to the next.
And what you believe, because you're going to hold this for a while, so you got to be with us for a while here. Don't tell me what the rents are today and what the valuations are today. Tell me can you sustain? Is that going to significantly rise, or is that a chance that it could come down?
Well, also, look, if I go get a loan on a commercial property, typically in today's market, I might get a 5-year fixed rate loan. And typically, a typical term of a lease on an industrial commercial building might be 5 years.
Right.
So guess what? In 5 years, I got an event, right? And so if interest rates come down and rates go up, I'm a hero. If interest rates stay where they're at and rates come back down, I get a double kick in the knees, and my investment just got significantly worse. And so people who are savvy about that look at it long term and go, I don't know if this is such a great thing. And so you're starting to see flattening. You're starting to see, so we have deals where we've seen the offers come in at well below the asking price, and then the property either sits or doesn't sell. And then we've seen stuff that's priced appropriately that will still sell very quickly because the price isn't a bad price. The other thing that you see, just as a side note,
right,
is this whole idea of getting worked over as the buyer, right? So if there were 10 offers on the property, you might just take the highest offer and it might be clean, and then you might just run. But now I don't have 10 offers. Nobody's got 10 offers on anything, but I might have 2 or 3. So what as a good broker would do is they would work the 3 offers. So if one is all cash but the price is lower because it's all cash, another guy needs a loan, needs more time to close, so he's willing to pay more because he knows he's got some other hair on his closing conditions. They go back to the guy who's all cash and work him up to try and get to the other guy's price. It's really not apples to apples, but as a good broker, that's what you would do.
Right.
And so we're seeing that, and then you're seeing either somebody just says, forget it, I'm out, or you get still a little bit of a mini bidding war, but you better go quick, because in this market where there's just uncertainty, time certainly kills deals. And so we did one where we represented the buyer and there were 17 offers on the property.
Wow.
And we overbid, all cash, no contingencies, and still didn't get the offer because some other person bid even more ridiculous than we did. And then after they did their inspections, they bailed, right? And so they said, forget it, the property's not in good condition. We're out completely. The seller went back and said, well, you overbid. What if we take a little bit off the price? And they said, no, there's no number. I just don't like it anymore, right? And so then they went to the number 2 person, which still wasn't us, and said, would you still pay what you were willing to pay before? And they said, no, we found another property. Then they went back to us and said, okay, would you still pay what you're willing to pay? And then my client said, should we do? I said, no, we shouldn't. Right? So let's tell him you want it, right? He says, I want it. I like the property. I said, fine, let's do it. Let's just cut something out of the price and see what happens, because they're just going down the list.
Yeah.
So at the end of the day, the client still overpaid over the asking, but less than what he was willing to bid in the first place. But look at all the effort that somebody had to go through, right? And so, or you have another property on a deal we were looking at where they had 10 offers, and then after they went through each offer, there's really only 2 real legitimate offers at the end of the day.
One of the things that strikes me is most of the people in this industry, in commercial real estate, tend to specialize. You, as a broker, do lots of different things, but as an owner, you own lots of mostly apartments. You don't own tons of industrial or offices, or maybe you own some of that, but you seem to kind of specialize in one thing or another. The people you brought in here kind of know one thing. Is that still the way forward, or do you have to know a little bit of everything? You got to spread the risk more. You got to be in multiple products here.
No, that was like 4 or 5 questions wrapped in one.
I know. I'm just trying to say, do people still specialize? I do high-rise. I do industrial.
So I would just say, look, on the brokerage business, when I got into the brokerage business, they said not only do you have to specialize in a product,
right,
but you have to specialize in a geographical area. So I went and interviewed with a firm, which we'll name nameless, but it was a big national firm, one of the biggest in the country, and they said, you could be the guy in the Irvine spectrum doing office space between this street and this street and that street and that street. And I said, what are you talking about? What happens if I get a deal and it's on the next street over? Well, you'd have to bring in the guy who's the expert in that market.
Yeah, right.
It's the next street over. I don't need any help, right? And then I said, look, if I can't be an expert in more than one market, I think I'm capable. And they said, well, that's how we do it, right?
Yeah.
That's the old school way, that you're a specialist in a particular market.
I do this neighborhood, I do this product. And
in residential, it's the same deal, right? I'm the specialist in XYZ neighborhood. Look, I explain it to clients this way. I'm a specialist in making deals. I know how to negotiate. I know how to make a deal, and I understand the markets. And while I might not be the guy who did most deals in a particular submarket, I might not be able to tell you every single tenant and every deal that got done in a particular market. I would tell you, Paul, if you were the CEO of a company and you were worried about paying your rent, right? Do you care about what the neighbor's rent is? You care about your own rent, right?
Yeah,
I care about my own rent.
Right.
And so I care about what I'm writing a check for, whether that's to buy a property or whether that's to pay rent or my client's rent. And so that's how we approach it as a company. Other companies are different. And so you do need to understand what the market is. At the same time, you also need to understand your own perspective. If you're going to buy this property and hold it for 30 years, do you really care what the neighbor paid? Right? And if you're going to buy this property, fix it up and flip it, do you really care what the neighbor paid if he's going to hold it? These are not the same dynamics. You have to make decisions based on your own personal situation or your own company situation. So you have bigger companies that specialize in industrial or specialize in office, and some of them try to diversify into other areas, but apartments and industrial are not the same.
Because you had one of your guests was on who does commercial real estate in the desert out in the Coachella Valley, and he used to just sell apartments. That's what he did. I sell apartments. I know apartments. He doesn't just do that anymore because there isn't.
Well, because that market's not deep enough to be able to support that.
Right.
But,
so now he's got to have more diverse talents.
Sure.
And
but
more
if you talk to an industrial broker in the San Gabriel Valley, they wouldn't tell you they do apartments in Orange County. That doesn't make sense. They specialize on a particular market, and that's what they look for. Now, I would also tell you as a broker, anybody else would tell you the same thing. If one of my clients called and said, "Hey, I know you specialize in the San Gabriel Valley, but I actually own a building in Newport Beach. Would you sell it for me?" The brokers are, greedy guys, and they just be like, sure.
Sure,
and they'd
we
say,
can do that.
Can you do that? Absolutely. Right?
No problem.
Just put a smile on and sell it.
Is that true for owners too? Do people, the Brookfields of the world that own the high-rise towers?
Well, Brookfield is a multi-billion-dollar investment company that has their own criteria, right? So I think they would tell you, well, I don't want to speak for them, depending upon what the deal was.
Let's get them on the show.
Yeah, if there was a good enough return, I would look at doing it. But, regardless of who the company is, if somebody said my deal range is 5 to 20 million and you brought me $100 million deal, I wouldn't do it. If somebody said I focus on California real estate and I brought you the best deal there is in Tennessee, you wouldn't do it. Other people will go wherever the deal is,
right.
and really it sort of depends. But, regardless of that, you have to understand where things are headed. And I just say, in terms of where we're at today, it's hard to pick where we're headed. I don't think interest rates are going to go back down dramatically. They may not go up dramatically. They may be the same. But here's what we're seeing. What we're seeing is the lenders, right? So to me, the other big factor of this disconnect between buyer and seller, the BS, if you will, from the broker just trying to get the listing and telling the seller whatever he wants to hear to just get his foot in the door. The proof in the pudding is the lender. Because the lender will dictate what happens to the buyer unless the buyer is paying all cash.
Right.
And so unless you're going to go get a guy who is coming up with a big deposit from an exchange or just a big deposit from cash that they're sitting on, they may have a different criteria. But somebody who's going to go get a loan of any degree, if the rents stink, the lender's going to lend less in today's market.
Right.
And if the property needs fix up, the lender's going to want to know how it's going to get fixed up. Now, what's also interesting is, and it's more prevalent in the apartment market, but also in some of the other, in the office markets as well, lenders used to look at properties located in low-income areas, and you would actually get a better rate because the government wanted them to make loans in underdeveloped areas. And so you could pick a city where the average income was X, and it fit the criteria, and I'd actually get a better rate in that particular city than I would in a different city.
Because they needed to lend to those
They needed
areas.
to lend. Today, that's not the case. Today, lender looks at it and goes, oof, that's a risk, right? You're in a tougher neighborhood. You have an older property. You have a property that needs fix up. There are other properties in the neighborhood with graffiti. That particular city's got a higher crime rate. And then they just attach a premium because they're scared, right? They're scared because they don't want you to default and they don't want to make a mistake. And on top of that, their debt coverage ratio, which is the formula that the bank uses to be able to calculate whether the property can actually service the debt, right? They're not coming off. So a typical normal debt coverage ratio would be 1.2. When the markets were hot, bank would go down as low as 1.0 or 1.1. They would make exceptions. Today, there's no exceptions, right? So all they do is cut the loan amount. So what happens is The bank says, look, I'll lend. I have money to lend, but it's going to be at a higher interest rate, and we're going to lend you less, which means as a buyer, you come up with more, which means we're back to this inverse cap rate versus. So if I could buy a property at a 7 cap and borrow at 7%, and the bank said, I'm going to lend you less and you have to come up with more, it's no harm, no foul, because the return is the same, right? But if the bank says, I'm going to lend you less at 7% and you have to come up with more, then you need more cash that you have to put into the deal. The bigger the loan you get at the higher interest rate, the tougher the property is to pencil. And so those are real live things. And then when I talk to other brokers about it, they go, yeah, no, I don't disagree with you, but that's the price. And then they go, well, I don't think my guy would take that price. Or I go, hey, you want X, you want $4 million for a property and it's a 4 cap. At a 5 cap, it's worth $3.5 million, right? And so I think that's a better number and more realistic. That's still less than the 7% interest rate. And I goes, yeah, my guy's not going to go there. Because people have a number in their head that they make up.
We talk about that all the time, yet getting through that imaginary number in their head here that they made up.
Right. So I say, look, if you have cash and you're on the sideline, you just be careful. You don't have to. Lenders say to me, Barry, you really want to make this deal? I go, well, it's all right. I'm not going to cry if I don't buy this property. Right? Even though it's 2 doors down from something else I already own, right? I would do it. It makes perfect sense. And I tell guys, I love the location. I love the property. I know the neighborhood. I'm your best buyer, but I'm not paying that price. That price is stupid.
Right.
Right? I mean, it's not even like, oh, it's a little bit of a premium. It's stupid.
Because if you control the whole neighborhood, or if you own a lot of property in one neighborhood, then you have more control over the general rents in an area, right?
Sure. Plus, I know what I'm getting. I mean, I know the neighborhood. It's not a stranger to me, right?
Right.
So people say, would you buy in Tennessee? No, because I don't own anything in Tennessee. Not only is it far away, I don't know that market. But the real issue here is going to be what happens with the lenders, right? And so if the lenders are continuing to be tough on the loan to value, to be tough on the underwriting, to not make exceptions on the debt coverage, regardless of the rate, you're just going to see less transaction because less people are going to be able to get loans that make any sense. Now, the other thing that's also interesting is that when the market wasn't so hot, a normal transaction you would have even if you were buying a home, you would have an appraisal contingency. In the California standard contract from the state, there is a clause that says appraisal contingency.
Right. Everybody this is contingent upon it really does appraise at that number.
Right. Hey, how do I know that the property is worth $1 million? What if it appraises for $800,000? Well, when the market got hot, people would just say, hey, look, I don't even care if it appraises, or I don't even want to do an appraisal, or if I'm getting a loan, I need an appraisal because the bank needs it, but I don't care if it comes in short, I'll come up with more money. I don't care. I just really want the property. Mm-hmm. So then that gets steamrolled into nobody needs an appraisal. And if you need an appraisal, you're just not going to make that a contingency, right? But the problem is if the bank winds up cutting the loan, you need more money in your pocket to come up with it. If you only had X and the bank was going to loan Y, and then the bank said, I'm not really loaning all of Y, you can't make the deal, can you?
No.
So I think you're going to start to see some other people either get boxed out of transactions, or you're going to start to see more contingencies. And if I have 5 offers, I'm not taking the guy with a bunch of contingencies.
No.
But if I only have 1 offer, I guess that's all I have to pick from. So I think that remains to be seen, right? And so you're going to get past on the residential side. You're going to get past the summer selling season here in about 60 days. Mm-hmm. On the commercial side, you're going to see that interest rates stabilize. Lending doesn't really change, and then cap rates will have to come up because stuff won't sell. And then I think the other thing is just going to be, again, do people believe that interest rates will pull back in 12 months? And I don't know. I mean, I guess we'll see in 12 months. In 12 months, maybe we'll have a better idea who's going to be president and what that MO means in terms of the economy.
All I hear is stay tuned again, and we kept thinking that by now there'd be some clarity in the crystal ball here.
To me, there's not much clarity other than be careful and then stick with what you know. And, if you're buying in the short, the guy who buys it to flip it and make a bunch of money, that is almost all completely gone.
Even a residential.
Right. And so just, make sure you're buying something that if you wind up keeping it for a long time, that you're okay with it. And then I think you'll be fine. But everybody's got a different set of motivations. And I believe there's still a disconnect between buyers and sellers out there.
You
and
say
that's
it all
gonna
the time.
continue.
They got different numbers, different ideas in their head when they're coming. One thinks it's got to be coming down, so I'm going to go low, and the other says, like hell, it's coming down. I don't care if it's coming down. I still want yesterday's number.
Right, but look, I'm not buying this betting on the future. I'm buying this in today's market on real world. You don't want to sell it to me in real world? Why don't you sell it to me in a year, and then we'll see what it's worth, right? The idea of buying it in the future, it has somewhat gone out the window. I mean, unless there's some blatant rehab.
But it was there for a while. You even said you had French ears, and you say, why'd you buy that? That doesn't make sense. I know,
Right.
but in the future.
Right. Or you talk to a guy that says, I talked to a friend of mine last week. He says, I bought my house a year ago and it's already worth 25% more. I go, are you selling it? No.
To be determined. Stay tuned. All the more reason they got to come in each and every week to Let's Talk Real Estate. Any plugs you want to give for any of your brokerage or anything else here?
I don't know. I would say if you're a company out there and you're looking at buying a commercial or industrial building, or you have a lease that's coming up, certainly the Saywitz Company, we're happy to help. We do handle all geographical areas all over the country. We're negotiating transactions in 20 or 25 states at any given time, and specifically focus on all of the submarkets in Southern California. Happy to help, happy to give a free consultation. In the interim, I would say stay tuned, stay in touch. We'll see you back here again next week on Let's Talk Real Estate. I'm Barry Saywitz. Thanks for tuning in.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.